Are you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. My podcast is to help you understand the mortgage loan side through my experience and knowledge. My name is Paige Ashby. Do you want to know what an interest rate buydown is all about? Well, let's get unpacking. With the market these days, high interest rates can mean paying extra monthly, can mean not being able to qualify due to a high debt ratio, can limit you on the purchase price. The benefit to a buyer is very clear if there is a need. Well, now what I mean by that is that most consumers refinance within 1 to 2 years. So the buy down of a rate must be a need to qualify, or this will be like their forever home. So they just want to lock in the rate as low as they can. For a seller concession, also known as a credit, can be offered to buy down the rate, which is a huge marketing and negotiating tool. This allows the seller to attract home buyers today instead of waiting for the rates to drop. As a seller, this credit comes directly out of your profit at closing. On the lending side, the cost to buying down the rate is called a discount point, not origination fee. I get a lot of people get these two mixed up. The discount point can be a write-off on your taxes. There's a benefit right there. So, of course, talk to your CPA to see if there's any rules that have changed. I'm not a CPA. This is just a known thing for the mortgage side. Now, did you know that there are two kinds of interest rate buydowns? The first one is called a temporary buydown. It's called a 2-1 buydown. This option is popular right now because this will give the home buyer a lower payment for the first 2 years. And ideally, they can refinance. So again, most people refinance within a year or two, whether it's to pay off some debts or do some home improvements. So the 2 buydown means the first year, the rate is 2% lower than the original locked-in rate. Then the second year is 1% lower than the original locked-in rate. Then after that, the original rate is locked in for the rest of the term of the loan, so you don't have to refinance if you don't need to. Now, the second option is called a one-time buydown. So at the time of the loan application process, you can choose what rate you want to buy down, and once it's locked in, then the rate is fixed for the lifetime of the loan. Now, this is a great option if you plan to live there forever. This is your forever home, or potentially you can rent it out later and turn it into an investment property. Now, the downside to an interest rate buy down is that it can be expensive depending on the market, but this cost can be a write-off. So because it's a discount point, you can definitely write it off on your taxes. With the unpredictable market right now, we can use all the tools we can get to market ourselves, whether we're buying or selling. Now, if you've enjoyed this information, make sure you give me a follow. And if you have anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and a mentor, if you have any questions or need a pre-qualification, please reach out to me at LinkedIn, Paige Ashby Lending, or my other contacts info are below, listed in all my episodes. Thank you so much for being part of Unpacking the Home Advantage.